where I kind of left off in bonds, remember the discussion about the Captain America movie, right? Where Captain America was basically selling what they call war bonds, where the government is trying to raise money from people to help pay for war stuff, bullets and guns and tanks and ships and all those things that cost money, right? And how I defined the bond was as a promise. So let me just refresh your memory for a second. So when I talked about a bond, remember at one point I drew a little picture of a bond, right? So this was what I drew. I think I drew something that looked like this. Here's a bond, and the face value is the value printed on the bond. This is not what we're going to pay to buy the bond. This is the face value of the bond, and that's the amount of money we get back at the end, the maturity period. And then remember I talked about these coupons, and all these coupons that you pull off every 6 months, and then you receive a so-called coupon payment every 6 months. But this bond, I said, is a promise, and it's a promise by whoever issues the bond. It could be a company or a government, and it's a promise of a cash flow. So you'll have some cash flow where every 6 months you receive one of these coupon payments, and we model those as an annuity, right? So these are what we call the coupon payments. And then this, luckily it starts with an F. It's a future value, but it's also what we call the face value of the bond. So the promise that I'm talking about is the promise of this cash flow. That's it. And in a bond question, our task is to figure out how much should I be willing to pay for that bond. And it's sometimes confusing people to say, oh yeah, we have $1,000 bond, but we're not going to pay $1,000. $1,000 bond means I'm going to get $1,000 at the end of the time to maturity. That's the other jargon word. So however many years, it's actually 6-month periods, however many 6-month periods there are, divide by 2 is the number of years to the time of maturity. That's when the bond kind of comes due, and the issuer of the bond gives the owner or holder of the bond the $1,000. Okay, so that's the promise that is real, a promise of a cash flow that is in essence what a bond is. Okay, and I might as well, since I've got it up here, I'm going to tell you what the conventions are. So a bond comes with a coupon rate, and we're not going to use the coupon rate as a time value of money interest rate. Okay, so the coupon rate is not a time value of money interest rate. It's a way of specifying how big these coupon payments are. So if I have something like a coupon rate, I'll write it like this: coupon rate equal to 10%. So a coupon rate of 10% means, and this is, you have to kind of just learn the procedure. It means I take 10% times the face value of the bond. So let's say we use this face value. If I take $1,000 face value and I multiply by 10%, right? So 10% of the 1,000, that's $100. Watch out for it though. Now what I do is I take the $100 and I divide by 2, because coupon payments are made twice a year, and this is just the convention. Okay, so don't think about this too much. So what that means is we have $50 every 6 month coupon payments. And you might say, what? Like, how the heck am I supposed to remember that? Well, you just are. And this is how the world of bonds works. And just remembering how you calculate the coupon payment is something you have to learn. And then I might as well carry on here. The question always becomes, what do I pay? What do I pay for this cash flow diagram? And that depends on your level of risk assessment of this amount. And traditionally, especially with government bonds, traditionally they're viewed as very safe investments. So you can't expect a bond to sort of pay a high rate of return, meaning I can't assign a high time value of money interest rate to this. For bonds nowadays, you're looking at something less than 1% as a time value of money measure of the riskiness of the bond. And the market really decides what people are willing to pay for bonds. Bonds get traded almost like shares, and the price of a bond is really a measure of how risky people perceive it to be. And the more you're willing to pay for the bond, then the more attractive this looks to you. So we'll be calculating, in essence, if you know all of the time value of money cash flow patterns, the calculating the P of a bond is pretty easy. Really, I'll just put it down here in front of me. It's the P simply becomes the present worth of the future value, the face value. So it's just F times the P given F for I and N plus the annuity times the P given A, I, N. That's it. That's how you calculate the present value or the price you're willing to pay in dollars for a bond. You just need to make sure that you decide on the right value of I. Now, let's try and do this problem. Relatively straightforward. I've even already kind of used some of the dollar amounts in here as examples. But if we have a bond, part of this course is about reading problems and extracting the information from the problem sort of as I read it. Okay, so we have to read engineering economics problems a bit like detectives. So here's how I'd read this. Noah buys a bond with a face value of $10,000. So I would say, okay, my face value is also my future value. F is 10,000. Okay. A coupon rate of 10%, let's just call it coupon rate is 10%. Remember, that's not my time value of money interest rate. That's just this coupon rate payment. And a maturity period of 20 years. N equals 20. And I'm just going to throw this in here because I know it's coming. Right? If its maturity is 20 years, and if this is a regular bond that pays coupons every 6 months, then I'm going to assume that my N is 40 6-month periods. Okay, everybody's okay so far? It says, what's the purchase price of this bond, the present worth? So this is going to give us the A, the annuity. We already know the future value. So what is this? So this is just going to be 10,000, according to the convention, 10,000 times 0.1 divided by 2. So that tells me that the coupon payment is $500 every 6 months. So this is my annuity, my A. So I have an F, I have an A, I have an N, that's going to be 40, but I don't have an interest rate to use in the time value of, let's keep reading. The present worth of a bond depends on the going interest rate. Okay. Let's assume that the buyer expects to earn 15% nominal interest on his investment compounded semi-annually. Okay, so basically what we're saying is that Noah looks at this bond. He knows the company or the government that's issuing it. Let's say it's a company. And he says, yeah, I need to come away with 15% as a rate of return on this investment. So the 15% compounded semi-annually tells us what to use in the time value of money. Now, what you'll see is that it's very convenient in bond questions to quote the interest rate as compounded semi-annually, right? Because then that gives us a 6-month rate, right? So if we know I is equal to 15% compounded semi-annually, that means that the I that I use for my 6-month periods is just 15 divided by 2. So that's that I for a subperiod. That this is R over M. So the R over M is going to be equal to 7.5% per 6-month period. Okay. So once we have this, I think we have all of the components that we need to write the time value of money equation for the present worth. Because if you go up here and we say, what's the purchase price? We assume that purchase price is today at time t equal to 0. So the purchase price, notice it has a capital P in there. That's a nice little hint that that's the P. Right? So the question I should have written is, what's the P? So I know I've got the A, I've got the A, I've got the F, I've got the interest rate, I've got the number of periods. So now I just have to come back to my time value of money equation, and I should be able to calculate the P. Maybe I can squeeze it up here. Let me see if I can I'll get it below that recording thing. So if we say the P is equal to the F times the P given F I N plus the annuity, the coupon payments, the A times the A given P I N. Okay, it just fits. So that's the form of the time value of money equation, and I have everything I need. The only thing to take note of that could be annoying is the fact that this 7.5 is not a nice round number. If that was a nice round number, that means I could go to the compound interest tables. Oh, thank you. Someone just corrected me. It's a good test to see how fast I reply to things that pop up in the chat. Boom, there, that wasn't too bad. That was under 10 seconds. So someone found my mistake. Yes, P given A. Thank you very much. I greatly appreciate that. 2 people commented on it. It doesn't say the time there. I think that was pretty quick. But so if I have all of these things, the only thing I need to be aware of is that the 7.5 is not a nice round number, which means I'm going to have to use the formula, right? So I'm going to use the formula for P given A to calculate this compound interest factor. So I'm going to erase this because I think on the next slide I do in fact have the actual numbers, and I think that the calculated amounts of the compound interest factors is also on there. So let me just get this out of the way. Yeah, so with this out of the way, yeah, we can see, yeah, we got this right. We got the A right. The I is 15 divided by 2. That's our 7.5. Yes, the N is 40, right? Not 20 because it's 6-month periods. Here's the compound interest. Well, here's the equation that I wrote up here, right? So this is the equation for the bond. And If you don't know where this is coming from, just think of it. Maybe I'll do it down here. You think of it like this. I have an annuity. These are all, and well, there's 40 of these. I won't draw them all. I'm going to put like a little break here. This goes up to 40. And this is our A. And then this is our F. And what I'm asked is, what's the P? So to find the P, I take the F and I move it back to time t equal to 0. That's this part of the equation. I take the A and I move that back to time t equal to 0. That's this part of the equation. So with this and this, move back to the present, that's the amount of money I'm going to pay. Oh, someone asked, should there be a minus, F minus A? No, they're all positive. It's a good question. They're all positive. You may be thinking of our mortgage trick. Our mortgage trick, how much is owing at the end of the term, that had a minus in there because we were letting the loan grow and then we were subtracting what we paid off. This has, in the cash flow diagram, the A are up arrows and the F are up arrows, so we're adding it all. Right? So we're adding it all. The P is the money that's going to come out of our pocket to buy it. What would go back into our pocket are all the coupon payments and the face value. So it's a good question, but it is a plus. Okay. Let me just finish this. Okay. So here we are. We've just written out this formula with all the numbers in it. Then I don't think I need to do it right now, but this 0.055419, right? That number comes from the P given F formula. And this number over here, the 12.59 something, that comes from the P given A formula for 7.5 and 40 for each of them. And you just for your own sort of satisfaction, you should see, well, I don't know how much actual satisfaction you get from it, but anyway, that should be what you get when you calculate all of this. And this is the amount that NOAA should be willing to pay for this $10,000 bond that pays a 10% coupon rate. So notice what he's paying. I see your question. I'll get to it in a sec. Notice that what he's paying is less than $10,000. When we find a bond that's trading or selling at less than its face value, we say that bond is trading at a discount. If it's selling at more than its face value, it means it's trading at what we call a premium, but it doesn't really matter. The dollar amount is calculated just the way it's calculated, so don't worry about those words. That's just some terminology you might hear. Someone asked if we'd ever be asked to find an F. Sure, right? So if you have an annuity and you want to find an F, you mean a bond question? Would we ever be asked to find the F? I would say that would be very unusual because it goes against what a bond is. Like a bond has to be printed with a face value. If you asked, what is the face value of this bond, then that would be an academically contrived question that tests your knowledge of this formula, which, that could happen. This is an academic course. So you could, in fact, be asked to find the F, in which case you'd have to sort of solve this as an equation. So someone else has a question. So someone's asked a question about the future profit, let's say, by comparing the calculated price and the face value. No, don't confuse those things. So listen, the concept of what you're willing to pay for a bond relates very strongly to an understanding of the time value of money. So I'll try to explain. If I'm NOAA and I look at this company bond and I say, I know what the future value will be 46-month periods from now. I know what I'll get. I know what I'll get for a coupon rate. But I also feel like I need to earn 15% on this investment, compounded semi-annually. But I need to earn 15%. That's my comfort level. That's my risk level. So if we know that Noah needs to earn 15%, that means I can take these known future values, and if I bring them back to the present using a time value of money interest factor of 15% compounded semi-annually, then these payments will be equivalent today to some dollar amount. It's the $100 today versus $100 a year from now question all over again. And all we're saying is that, hey, we're going to give you $100 a year from now. How much are you willing to pay for that today? And Noah says, well, I need to earn 15% on that. So then you discount that future value to the present, and then you figure out that's what he's willing to pay. And it's based on the idea of equivalence. Okay? I mean, to some extent, I know I'm a little bit over time. I'll stop in a sec. To some extent, you should always be able to put these problems in the context of a would you rather. You know, and for Noah, if we say, would you rather have these coupon payments in this future value, or would you rather have this, $6,851? And if Noah says, hey, I'm indifferent, that means we've found the magical value that he's willing to pay based on his interest rate. Okay, that's take some time with these concepts and try to absorb them. They are important, and you will use them again somewhere in your life.